Important note, this video is not financial advice. Always do your own research before making any investment decision. Past performance does not guarantee future results. Here's your market briefing from Rumour with AI. Russia's crypto infrastructure is undergoing a rapid, unregulated expansion as the country prepares for a sweeping new regulatory regime. Sales of hardware wallets have surged 84% year-over-year, driven by major retailers Wildberries and M.Video. This doubling in demand signals a defensive posture among Russian consumers ahead of the September 1st implementation of stricter cryptocurrency rules. The surge highlights a growing disconnect between state policy and grassroots adoption, as citizens seek to insulate assets from potential capital controls or seizure. Meanwhile, the global retirement savings model is facing a critical stress test. Standard 60/40 portfolios, long considered the bedrock of conservative investing, may no longer be sufficient to fund decades of retirement. Analysis suggests that passive funds are lagging behind inflation and longevity risks, creating a significant shortfall. To bridge this gap, investors are being forced to consider aggressive shifts toward higher yield, volatile assets. The math is unforgiving. Without increased risk exposure or extended working years, the traditional retirement path is mathematically broken for many. On the macro front, geopolitical tensions are reshaping currency markets. Canada has proposed significant trade concessions to the United States in a desperate bid to avert 50% tariffs on its exports. Negotiations are intensifying ahead of the August deadline, with the Canadian dollar reacting sharply to every diplomatic leak. The threat of such steep tariffs would devastate Canadian manufacturing and energy sectors, forcing Ottawa to offer unprecedented access to its markets in exchange for stability. The Canadian dollar to US dollar pair is now a proxy for North American trade relations, swinging wildly on the slightest hint of progress or breakdown. In the digital asset space, the shadow of FTX continues to loom over exchange solvency. For years after the collapse, while major exchanges have proven asset control, they continue to obscure true liabilities. Recent analysis reveals persistent reserve gaps and technical limitations that mask underlying risks. Investors are increasingly scrutinizing the difference between claimed reserves and actual, liquidatable assets. The legacy of FTX has not just changed regulations, it has created a permanent skepticism that requires deeper due diligence than ever before. Looking ahead to today's release, the market is holding its breath for central bank signals. Although no major high-impact economic calendar releases are scheduled for the next 36 hours, the anticipation of Federal Reserve rate cuts is already pricing in. This expectation is driving precious metals higher. Gold prices in Canada have surged 3.5% to $43.51 per unit. The Bank of Canada and the Fed are both signaling a pivot, boosting demand for the safe haven asset. As interest rates fall, the opportunity cost of holding gold decreases, making it an attractive alternative to yielding bonds. The convergence of regulatory fear in Russia, structural deficits in retirement planning, trade wars in North America, and monetary easing globally creates a complex landscape. Investors must navigate these overlapping risks with precision. The days of passive, set-and-forget investing are over. Active management and geopolitical awareness are now essential components of any serious portfolio strategy. That's your market briefing. Follow Rumour with AI for daily market intelligence.